Most people see the price of silver the same way they see the price of a stock or a loaf of bread. It looks like a simple number that goes up when demand rises and goes down when demand falls. But the silver market is not just a number on a chart. It is a network of vaults, industrial factories, mining companies, global trade routes, and financial contracts that interact with each other in complicated ways. The price you see on your screen is not just the cost of a metal. It is the outcome of a system trying to balance physical supply with financial speculation. To understand what silver actually represents today, it helps to step back from the idea that markets are only emotional or manipulated. Markets can be influenced by emotion, but they are built to serve a purpose. The silver market, like other commodity markets, was not originally created to give investors a way to gamble. It was designed to help businesses survive. Imagine you own a solar panel company or an electronics manufacturer. You need silver to build your products, but you don't want your profits to disappear because metal prices suddenly spike. Instead of risking everything on unpredictable price movements, you can lock in a price ahead of time. That is what a futures contract is for. It gives companies stability so they can keep operating. On the other side of the transaction, consider a mining company. A mine might take years to develop and produce metal. Miners do not want to finish their work and suddenly face a much lower price when they try to sell. Futures contracts protect them from sudden downturns. Both miners and manufacturers use futures to secure predictable business activity. Speculators, who buy and sell contracts without needing metal, enter the picture later. They make it easier for everyone involved to buy or sell quickly. When speculation stays reasonable, it adds flexibility and liquidity to the market, making it work better for real producers and real users. Because speculation is so active in the modern financial world, many more contracts are traded than actual silver bars are delivered. Most traders never take physical delivery. They simply trade based on price movement. This makes the financial side of silver much larger than the physical one, at least on paper. But this does not automatically mean something dishonest is happening. It simply shows how many different kinds of participants exist within the same market. One side is focused on physical metal, another on financial strategies, and a third on industrial long-term planning. These groups do not always move at the same pace, and sometimes their priorities conflict. That is when confusion begins for the average observer. When people look inside major silver vaults, like those connected to futures exchanges, they often see a large amount of metal and assume that is how much the market is working with. But silver stored in these vaults is not all the same. Some of it is sitting there as private property. Some of it is available to meet delivery requests from futures contracts. The difference matters because only a portion of the metal in vaults is actually meant to be used for settling obligations. Much of it is simply being stored and has nothing to do with market activity. It is there the same way you might store your valuables in a bank safe. It belongs to you, but it is not for sale. This is why silver in vaults is separated into two categories. One category represents privately owned silver that is being stored safely, not intended for delivery unless its owner decides so. The other category is silver that has been formally designated as available for delivery to someone who has a futures contract. When analysts talk about changes in silver inventories, they are usually referring to the portion of metal that is designated for settlement. If that category gets smaller, it doesn't mean the world is running out of silver. It simply means less metal is available for immediate delivery through the futures system. That scenario does not automatically lead to market failure, but it can require cooperation. If there is ever a strong need for delivery, private owners may decide to shift their metal from private storage into the deliverable category. They are not required to do this, but they can. The market depends on incentives, not force. Because the futures market is so influential, there are times when the price reflects the behavior of financial traders more than it reflects physical demand. A large hedge fund might sell contracts rapidly because interest rates are expected to rise, even if factories are still buying silver for production. A manufacturer might continue buying large amounts of metal even if prices rise sharply because they cannot delay production based on short-term movements. These different priorities mean that price does not always move in sync with physical need. The financial side reacts quickly to global conditions. The industrial side reacts slowly and steadily because they are producing products, not trading charts. If you look closely at historical silver data, you will notice that the price has not always jumped when supply becomes tight. That is because price is influenced by two worlds, the world of traders and the world of manufacturers. These worlds intersect but do not operate at the same speed. An investor might sell silver because they expect an economic slowdown, while a solar company might increase purchases because their production goals are scheduled years ahead. The futures market can temporarily soften the impact of physical scarcity because it allows financial supply to exist without immediate physical metal changing hands. Instead of viewing this combination as suspicious, it is more accurate to see it as a form of stability. A world without futures markets would leave companies exposed to sudden price swings, and investors would face enormous volatility with no ability to hedge their risks. That would make industries unstable and hurt long-term technology growth. The existence of paper contracts allows the system to function without constant disruption. Prices may not always feel accurate to everyone, but they allow businesses to survive. For any futures market to work, people must trust that delivery is possible if they ask for it. That trust doesn't depend solely on how much metal sits in vaults. It depends on the belief that contracts will be honored and that participants behave rationally. As long as prices remain believable and delivery remains possible, even if infrequent, the market continues to operate. If large investors suddenly demanded delivery all at once, every market in the world would face stress. Not only silver. The system is built on cooperation and confidence, not fear. The silver market is not a ticking time bomb or a guaranteed windfall. It is a system balancing real industrial needs with financial hedging. It is influenced by global economic policies, mining constraints, and technological evolution. Understanding it does not require panic or optimism. It requires observing how the financial side and physical side overlap. One side protects companies from unpredictable costs. The other moves metal into products that serve modern life. Silver is an industrial necessity at the same time that it is an investment asset. That dual identity makes it unique. The futures market gives companies a way to survive long-term, while factories and manufacturers quietly use more and more of the metal in real products. If someone only watches the price chart, they will miss the bigger picture. The real story of silver is not just about price movement, but about how modern technology continues to rely on it more every year. What happens in the future depends on how mining production, investor behavior, and industrial demand continue to interact. Nothing in this market is automatic or guaranteed. The value of silver develops through a slow competition between how much the earth can supply, how much industry needs, and how financial markets manage risk. As we move forward into energy transitions and new technologies, that balance becomes more interesting, not more frightening. The next chapter of the silver story comes from industry, not speculation. And that is where the modern narrative truly begins. Silver is often discussed as an investment, but its role in modern technology is what truly defines its future. Many people think of silver as a precious metal, something used for coins or jewelry, yet its greatest value today exists in places most of us never see. Silver hides inside phones, solar panels, electric vehicles, medical equipment, satellites, and countless everyday products. These industries do not think of silver as a tradable asset. They see it as a component that cannot be replaced without sacrificing performance. When we talk about silver today, we are no longer just talking about money. We are talking about infrastructure. The connection between silver and technology is not simply a modern trend. It is the result of a property that silver has always possessed. It is the most conductive metal on Earth. No other metal transmits electricity and heat with the same efficiency. For decades, engineers and scientists have tried replacing it with cheaper materials like copper or aluminum, but performance drops quickly. When a phone overheats, loses signal, or charges too slowly, it becomes a real problem for the manufacturer. Silver fixes those problems. Even when companies try to reduce the amount of silver they use, they still end up needing some. As technology becomes more advanced, the need for precision increases, and the role of silver becomes even more important. The most dramatic example today is solar technology. Solar energy used to be a niche market, something mainly discussed by environmental enthusiasts. Today it is becoming a global priority. Nations are committing billions of dollars to renewable energy infrastructure. Solar farms are being built in deserts, on rooftops, across highways, and even on the surfaces of lakes and reservoirs. When governments invest in new energy systems, they do so for decades, not months. These projects need reliability, and silver provides that reliability. Without silver, solar panels would lose efficiency and produce less power. Even a small reduction in efficiency becomes extremely expensive when multiplied across thousands of panels. For solar manufacturers, paying a little more for silver is cheaper than producing less energy. What surprises many people is that newer solar technology is using more silver, not less. At first glance, that seems backward. Normally, industries get better at reducing material use as systems improve. With solar panels, the opposite is happening because the demand for higher efficiency requires better electrical conduction. Newer types of solar cells, which are rapidly replacing older ones, require noticeably more silver to operate at peak performance. This is not a design flaw. It is the result of physics. No policy, invention, or wishful thinking has changed the fact that silver provides the best path for electrons to travel. That is why even small improvements in efficiency require more silver, not less. Industries that rely on silver do not respond to market volatility the same way investors do. A manufacturer cannot stop production just because silver gets more expensive. A solar company with billions of dollars invested in orders, land, equipment, and labor cannot pause because they dislike market prices. They must buy silver whether the price is high or low. Their demand is not emotional, it is mathematical. If the silver price doubles, they will still need it. If it triples, they will still need it. The need does not disappear. This type of demand is described as inelastic, meaning the demand stays strong even if the price rises. That gives physical silver a unique form of stability that the price chart does not fully show. Industrial demand is only one side of the story. The other side is supply, and that story is far more complicated. Many people assume that when demand rises, mining companies simply dig up more metal. That idea works for crops, oil, or lumber. It does not work the same way for silver. Silver has a geological limitation that makes supply increases slow and unpredictable. Unlike gold, which is often mined directly, most of the world's silver is not found in silver mines. It comes from mines that are looking for completely different metals such as copper, lead, or zinc. In those mines, silver is a byproduct. No matter how high silver prices go, these mines will not operate faster just to produce a small amount of silver on the side. Their revenue depends on the primary metal they are mining. This disconnect between price and production makes silver fundamentally different from other commodities. Even the mines that do focus primarily on silver are facing challenges. Mining was once easier when surface deposits were rich and accessible. Those high-quality deposits have been extracted over time. Mining companies today must dig deeper and process more rock to extract the same amount of metal. This increases costs, energy use, and environmental impact. As ore quality declines, silver becomes harder to supply even as demand increases. The world has reached a point where silver production is not keeping up with consumption. For several consecutive years, the world has used more silver than it produces. When that happens with other commodities, the price quickly adjusts to correct the imbalance. With silver, financial contracts make the adjustment slower. The price reflects financial trading more than physical scarcity, at least for now. This gap between financial trading and physical consumption creates a misunderstanding for investors. Someone can look at a price chart and conclude that silver is not scarce because they do not see a dramatic price surge. Yet if they walk into certain industries, they would see companies quietly securing massive supplies of silver because they cannot risk interruption. These buyers do not announce their actions publicly. A solar manufacturer does not warn the world that they are concerned about supply. They simply purchase what they need, sometimes years in advance, and secure contracts that guarantee delivery. When large industrial buyers plan ahead, the public rarely hears about it. The market adjusts slowly, not dramatically, through long-term commitments. A second factor shaping silver supply is geography. Silver production is concentrated in a few countries, and many of those regions face their own economic and political challenges. If environmental regulations change, if energy costs rise, or if local governments adjust their mining policies, production can slow. These disruptions do not appear immediately on global news. They accumulate quietly, affecting total supply gradually. Meanwhile, demand continues to grow because technology does not wait for markets to stabilize. Factories cannot pause development for geopolitical reasons. They continue building and they continue consuming silver behind the scenes. This dynamic is further complicated by global trade. Not all silver that is mined remains within a transparent financial system. Some is shipped directly to industrial centers where it disappears into manufacturing processes. Once silver is turned into components inside a solar panel, a medical device, an electronic circuit, or a battery system, it does not return to the market easily. Recycling can extract some silver, but it is often uneconomical because the amounts are small and hidden inside complex devices. Unlike gold, which is stored and recycled, silver is often consumed permanently. This makes above-ground inventories shrink over time even as production continues. Investors who only track silver through financial markets might never see this consumption. They might assume the market is stable because futures contracts continue to trade normally. Yet the metal itself is slowly leaving financial circulation. That does not mean a sudden crisis is guaranteed, nor does it imply a specific price outcome. It simply means the relationship between physical silver and financial markets is changing. The balance that existed decades ago is not the same today. As industries consume more metal, the portion of silver available for investment becomes proportionally smaller. The future of silver is not built on speculation about dramatic market events. It is built on practical realities shaping technology, energy, and manufacturing. Silver is not being driven by investment demand. It is being driven by global infrastructure. This transition marks a turning point for how the metal is understood. Investors may continue to debate its price, but engineers and manufacturers quietly treat silver as an essential ingredient of modern life, not a speculative asset. That practical demand will continue shaping the market long after price watchers have moved on to other trends. Silver is becoming less visible as an investment and more important as a foundation of technology. This shift may not create sudden market shocks, but it will create long-term pressures that slowly reshape how silver is traded, stored, and valued. Understanding this shift does not require predicting market dates or dramatic events. It requires recognizing that the metal is leaving the financial world and entering everyday life. Once it is inside technology, it does not come back easily. The future of silver sits not in vaults, but in the circuits, panels, and systems that power the modern era. Silver's movement around the world is not only shaped by technology and mining. It is also influenced by the decisions of governments, trade policies, and strategic economic planning. While investors in the West often focus on charts, contracts, and future prices, many countries quietly treat silver the same way they treat energy, food, or industrial resources. They do not buy it because of market trends. They buy it because they want to secure long-term stability. This difference in mindset is crucial for understanding how the global supply of silver is being reshaped. Some countries have already begun accumulating large amounts of physical silver, regardless of short-term price fluctuations. They are not necessarily stockpiling it in order to sell it later. They are preparing for a future in which industrial growth depends on reliable access to critical materials. Silver fits directly into that category because it plays a role in renewable energy, electronics, medicine, and infrastructure. Governments planning decades ahead do not think about investment returns the way a short-term trader does. They think about securing the raw materials required for future industries. The clearest example of this strategy can be seen in countries with growing populations and expanding manufacturing sectors. These nations are building factories, upgrading power systems, and investing heavily in solar and electronics. For them, silver is not a commodity, it is a building block. When they purchase large quantities, they are not speculating. They are protecting their long-term industrial capacity. This approach makes silver less available to global markets, not because it is being hidden, but because it is being used. The movement of silver between regions has also been influenced by trade agreements and logistical changes. When tariffs are adjusted or import policies are restructured, metals begin to flow through new channels. Once these channels form, they often remain in place for years. A single trade agreement can shift how thousands of tons of silver move around the world. These agreements may not mention silver directly, but they can dramatically reduce taxes or shipping costs, encouraging buyers to import more material through specific routes. When new trade routes open, metals can bypass traditional financial centers entirely. Historically, large exchanges in places like London and New York were the primary hubs for buying and selling metals. Today, more silver is traveling straight from mines to industrial centers without ever entering those traditional systems. That does not mean anything secret is happening. It simply reflects a more efficient global supply chain. Manufacturers are increasingly trying to avoid the delays and complexity of middlemen, if they can buy silver directly from producers, they do so. As more silver moves through these direct channels, less of it becomes visible in market inventories that traders follow. This shift contributes to a situation where financial markets may show that silver supply appears stable, even though physical inventories are gradually declining. It is not that metals are disappearing mysteriously. They are being used in products with long lifespans. A solar panel installed today may remain in service for 20 to 30 years. A medical device may not be dismantled for recycling until it is obsolete. A circuit board inside technology may never be recycled at all. As more silver is absorbed into durable goods, less remains available for trading. Another factor influencing silver availability is the nature of industrial contracts. Large manufacturers often secure supply years in advance. These agreements lock in deliveries of physical metal for a fixed period, regardless of what market prices do later. When these contracts are signed, they reduce the amount of silver available to everyone else. Yet retail buyers never see this happen. They only notice after the fact when inventories appear lower and prices react slowly or unevenly. Because these contracts are private and long-term, their impact is rarely visible on public charts. The difference between financial supply and industrial supply becomes more noticeable during periods of economic uncertainty. When global markets slow down, investors sometimes sell assets, including precious metals. That might cause prices to appear stable or even fall temporarily. Meanwhile, manufacturers continue to use silver at a steady pace because production schedules do not stop simply due to market sentiment. This imbalance can create the illusion of abundance when the physical reality is the opposite. A price chart cannot show how much silver has already been committed to future industrial use. Even physical vault inventories do not always reflect true availability. A portion of the metal stored in vaults is not for sale. Some belongs to private or institutional holders who treat it as long-term security rather than inventory meant for trade. These holdings can exist within the same storage systems that supply industrial buyers, yet they are not part of the usable supply. That separation can be difficult to recognize from outside the industry. An investor may assume that all vaulted metal is accessible, but only a fraction actually is. The rest functions like storage, not liquidity. This distinction is important because it shows that supply cannot be measured only by what exists. It must be measured by what can be used. When metal is locked in storage or committed to private agreements, it becomes functionally unavailable. It may appear on balance sheets, but it does not circulate. This is why the number of ounces stored above ground does not necessarily translate to real market access. The difference between what exists and what is available is growing wider each year as industrial use increases. These dynamics reveal that silver has two separate identities. In the financial world, it behaves like a tradable asset with fluctuating prices influenced by contracts, speculation, and trading volume. In the industrial world, it behaves like a strategic material with consistent demand and decreasing elasticity. Investors often see only the first identity, while manufacturers operate entirely within the second. As these two worlds drift further apart, misunderstandings can grow. Someone might look at price stability and believe demand is weak, unaware that long-term industrial needs are quietly consuming the supply. This divide does not require dramatic predictions to understand. It simply highlights that silver's value is increasingly tied to its function, not its symbolism. As technology spreads into every part of life, materials that enable that technology become priorities. Silver's role in energy, electronics, and medicine makes it increasingly essential. The more society depends on systems built from silver, the harder it becomes to treat the metal purely as a financial commodity. Its value becomes practical, not speculative. The transition from a financial metal to an industrial cornerstone is already underway. It will not be sudden or explosive. It will be gradual, marked by consistent demand and slowly tightening supply. The shifts in trade policy, manufacturing strategy, and global technology adoption reflect a world that is unknowingly redefining the meaning of silver. The change is not happening on market charts. It is happening in factories, laboratories, and government planning offices. Understanding this transition requires looking beyond price movements and recognizing how deeply modern life depends on a metal that rarely receives attention outside investment circles. The most important question is not whether silver will rise in price, but how societies will respond when their industrial systems require more of it than the market can easily provide. A modern economy cannot function without the materials that power its electricity, communication networks, medical equipment, and renewable energy. When demand becomes a necessity instead of an investment choice, silver's role changes from that of an optional asset to a required infrastructure component. At that point, discussions about price become secondary. The real challenge becomes ensuring access. Industries do not wait for the perfect market moment to secure essential materials. They plan for years or even decades. If a company building solar infrastructure believes future supply could be uncertain, they do not gamble on future prices or availability. They lock in long-term supply agreements to protect their projects and budgets. This creates a situation where large portions of future silver production may already be spoken for before it is even mined. Investors may be waiting for price movement, unaware that much of the metal has already been allocated to industrial commitments that do not appear on public charts. The outcome is a slow but steady tightening of physical availability. No single event causes the change. There is no dramatic headline that announces it. Instead, it unfolds quietly through growing industrial contracts, expanded manufacturing capacity, and supply chain agreements that prioritize factories first and markets second. The traditional pricing centers, which once controlled the flow of metals, slowly lose influence as more transactions bypass them entirely. Silver moves directly from source countries to industrial hubs, never entering the financial exchanges that many investors still rely on for market information. This separation does not mean investors will lose access overnight. Markets rarely switch off unexpectedly. What usually happens is that physical availability becomes harder to find in retail channels, especially during periods of increased industrial demand or global uncertainty. Dealers may find themselves unable to restock inventory quickly. Premiums may rise even when global spot prices remain steady, confusing people who do not understand the difference between financial price and physical cost. When a product is essential, its price is influenced more by real usage than by trading screens. It becomes less of a speculative asset and more like a vital component whose value is determined by function. History offers examples of how governments and industries adapt when a resource becomes strategically important. Decisions are not driven by the interests of individual traders, but by broader economic needs. A country must keep its power grid running, maintain technological development, and protect its industrial base. If critical metals are needed to maintain that stability, governments act to preserve access. They may encourage stockpiling, support domestic mining, or develop long-term partnerships with producing nations. These actions are not taken to influence price charts. They are made to protect national priorities. As renewable energy continues to expand and as technology becomes even more integral to everyday life, silver's use will likely increase at a pace disconnected from investment cycles. This means that even if financial sentiment declines during an economic downturn, industrial demand may continue rising. Consumers might spend less on electronics temporarily, but governments and corporations will continue investing in infrastructure, energy, and technology development. These sectors do not operate on short-term emotion. They run on multi-year budgets and strategic plans. The disconnect between physical use and financial trading may cause moments of confusion. There could be times when the market price appears flat or subdued while supply becomes meaningfully tighter behind the scenes. Investors who focus solely on charts may assume nothing is changing, unaware that factories are consuming more metal every year. Meanwhile, industries may increasingly focus on securing materials before projects begin, rather than buying on the spot market. The futures system, once the dominant tool for managing risk, may gradually become less central as supply chains reorganize around direct sourcing. In this changing environment, physical silver may quietly become less accessible to everyday buyers. Not because it is being withheld, but because it is being used. The more it is built into infrastructure, the less likely it is to return to the market in a form that can be easily recycled. A solar panel installed on a rooftop for decades is not a coin sitting in a drawer. A medical device is not a bar in a vault. The permanence of use is part of what makes industrial demand unique. Once metal enters the physical world of products, it becomes a resource embedded in society, not a circulating commodity. This gradual shift suggests a future in which the conversation around silver becomes less about speculation and more about access. Investors may increasingly view silver not for short-term profit, but as a material representation of technology's foundation. Industrial users may think less about price and more about supply security. Governments may think less about trading markets and more about long-term national resilience. In this environment, silver's role becomes broader than investment trends, acting as an invisible support beam for the systems people rely on every day. The silver market will not be defined by sudden shocks or dramatic collapses, but by the consistent pressure of industrial needs meeting the limits of global production. These limits do not have to create panic or crisis. They can instead be seen as signals that economies are transforming. As technology evolves, the importance of critical materials grows. Prices may respond in their own time, but the true value of silver will likely come from how deeply it is woven into modern life. The future of silver is not built on forecasts of explosive price increases or predictions of market upheaval. It is built on the quiet reality that societies are becoming more dependent on materials that enable electricity, communication, medicine, and renewable energy. Understanding silver means understanding that we are moving into an era where resources matter because they support the way civilization functions. A story is not about scarcity in a dramatic sense. It is about priority planning and the steady evolution of global industry. As this shift continues, the most important perspective is not fear or excitement, but awareness. Knowing how critical materials fit into the structure of modern life helps individuals, industries, and governments navigate their decisions with clarity. Silver is more than a commodity chart, it is a reflection of humanity's technological path. And as that path continues to expand, the metal that makes it possible gains significance in ways that price alone cannot fully capture.